Hey everyone, welcome back to Corporate Decoder, the place where we take a peek behind the curtain of corporate America. Today we're diving into a Form 8K filing from Next Technology Holding, and let me tell you, this one involves crypto stock and a whole lot of numbers. It's a bit like a digital treasure hunt where we see if the pirates bury or find the loot. This filing is a current report, basically an update the company is required to file with the Securities and Exchange Commission to keep investors in the loop about major events. Think of it as corporate real-time updates. In this case, the event happened on March 12, 2025. The main story here is that Next Technology Holding finalized a deal to buy a bunch of Bitcoin using a mix of cash and stock. It sounds like a big swing, so let's break it down. Back in September of 2024, the company announced it was going to buy Bitcoin BTC from an organization that helps its members sell them. The deal was called the Amended BTC Contract, and it said that Next Technology Holding could buy up to 5 TI and 167 Bitcoins from the members of this association. This would be over a year ending in September of 2025, and they'd pay $30,000 per Bitcoin. The company wanted to purchase 5,000 Bitcoins. Now, remember that there was an earlier payment of around $12 million. This would go towards the 5,000 Bitcoin purchase. Then they'd pay the remaining balance by issuing over 135 million shares of their stock, valued at just over $1 per share. They would also issue warrants. Think of warrants as options to buy more shares at a set price, which in this case would be at a nominal cost, almost free. So on March 12, 2025, the company finalized this deal. They got their 5,000 Bitcoins, and in exchange, they handed over the shares of stock and the warrants. And get this, the people who received the warrants, the BTC sellers, then said they wanted to use those warrants immediately to buy all the shares they could. So the company issued those shares right away. It's like a complex dance with money and digital currency. Now, here's a key point. The company didn't register these stock shares or warrants with the Securities and Exchange Commission (SEC). Usually when a company sells stock, it has to register it. This means giving the SEC and the public a lot of information about the company and the stock offering. However, there are exceptions. Next Technology Holding is saying they used an exemption, meaning they didn't have to register. One exemption is called Regulation D, and another is Regulation S. These both have rules about who you can sell to, how you advertise the sale, and other things. The company states they believe these sales were private transactions that didn't involve general advertising to the public. So what does all this mean? Well, Next Technology Holding now has 5,000 Bitcoins, but they've also issued a lot of new stock and warrants. This can impact the value of the existing shares, because more shares could dilute the value. Now let's put on our Warren Buffett hats. Next Technology Holding has made a bold move into the world of cryptocurrency. Buying 5,000 Bitcoins is a significant bet, and it looks like they valued each Bitcoin at $30,000. Whether that's a good price or not depends on where Bitcoin goes in the future. The company paid for this deal with a mix of cash and stock. That's fairly common, but it's worth noting that they issued a lot of new shares. Issuing new shares dilutes the ownership of existing shareholders. Think of it like cutting a pizza into more slices. Each slice gets smaller. This dilution is partly offset if the value of the company increases, but if the Bitcoin bet does not pay off, then this value could drop quickly. The warrants also add another layer of complexity. Remember, warrants give the holder the right to buy shares in the future at a set price. In this case, the warrants were exercised almost immediately. This shows that the sellers likely believed the value of the stock would go up. So what do we make of this? On one hand, Next Technology Holding is embracing a new technology and potentially expanding its business into a hot area. On the other hand, it has taken on some risk by buying a large amount of a volatile asset, and they did this by diluting their stock. The success of this move hinges on Bitcoin's future performance. If Bitcoin goes up, the company could look like geniuses. If Bitcoin crashes, well, not so much. It's a high-stakes gamble, and investors should understand the potential rewards and risks before jumping in. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives.